As markets continue to push to new record highs, our next guest says he has some concerns about liquidity and offers his insights about where he's seeing short-term opportunities. Joining us now is Jack Caffrey, equity portfolio manager at JP Morgan Private Bank. Jack, welcome. Good morning to you. What do you mean worries about liquidity? I thought we had tons of liquidity around.
Well, we have tremendous liquidity when we think about what central banks are doing. But if you look over the past year, you've had about 7.2 billion shares changing hands on a daily basis. Over the past month, you've actually seen that drop to about 6.2 billion. And when we look back at what's gone on, you would normally think when earnings are being reported, portfolio managers are repositioning, traders are acting on that news. Why is it we're seeing only 85% of the volume actually changing hands? And I think that's resulted in more dramatic stock moves. If you've had good news, you've managed to move higher. If you've offered more cautious guidance, you see yourself down 5-7%, which feels like a much more aggressive move relative to the quality or the content of what is you're actually saying. So it feels as though people are reacting a bit more than they're thinking through or responding. And when we go back and think to last year at this time, really going into December, it kind of felt like if you wanted to bid for something when you were trying to sell it, it felt like you were calling a lot more people or reaching out to a lot more people in order to actually complete those transactions. So we're going to the holidays. Liquidity naturally dries up a bit around that time of year. And it just feels like markets are a little drier, despite the fact this perception that central banks have put tremendous amounts of money out there.
Why do you think this is happening? I mean, is it a combination of fewer shares available to trade on the market because of buybacks, et cetera? Is it that portfolio managers are just complacent at this point?
I think it's an interaction of a couple of issues. One, I think part of it is the rise of ETFs. Because instead of having to trade 500 stocks, you can just trade one in the form of an ETF. And that might give some false sense of security or some false sense of liquidity. I can change the risk characteristics of my portfolio by just moving up or down a factor or some tracking issue around a factor. I actually would say that the reduction in share counts or the reduction in companies actually makes equities more valuable. There are fewer things you can own today that are actually growing earnings and give you that chance to participate in earning streams in the long run, which have created wealth. But at the same time, buybacks, and you'd actually argue buybacks are a bid in the market on a consistent or recurrent basis, also supportive of valuations overall.
So is that why we're sticking at record highs at this point? People aren't trading as much. They're just sort of holding on to their positions.
I think we have this idea that the way you've created wealth is taking that longer term perspective. And so being able to be calmer, thinking about how you build a portfolio that can allow you to participate and protect at the same time has been very helpful, very constructive for most people over the longer term. But at the same time, news has gotten better. We keep hearing we're going to have phase one of a trade deal. It's coming. It's coming. It's a little bit more vaporware, it feels like right now, in terms of it'll get there eventually. But that's something markets are willing to hold on for.
So you like cyclicals. What does that tell us about how you view the economy and where we are?
I think if you start with the data got better, or at the very least it stopped getting worse. And then you actually start seeing some positive economic surprises. That moved its way in the cross-asset markets. You started to see it in the yield curve backing up, the 10-year backing up, copper trading better, copper doing better than gold, a lot to suggest that things are doing better. Now you're seeing the parts of the market do better that tell you the economy is doing better. It's financials, it's industrials, it's the semiconductor industry. And so that suggests that for now, seasonally, I think you want to be a little bit more risk on in your positioning. Think the window is open in order to try to make some money in the stock market. But depending on your horizon, and the portfolios that I run specifically have sort of a 3 to 4 year horizon. So it's much harder to reposition around this idea right now that markets are embracing risk. It's not the bad 4-letter word. It's actually the good 4-letter word.
Why do your accounts have a 3 to 4 year time horizon?
I think when we try to come back to this idea that real wealth has been created by owning good businesses at good prices and allow them to compound, not having to earn back what I might be paying away in short-term capital gains. And so how can we look for a good business that is available to you at a reasonable price today and stay with it?
No. The reason I was asking is why I didn't know if that was an age issue in terms of who your clients are, if that was something where you said yourself it's not 10 years or 20 years.
No, I tend to think, I think you can have a reasonable idea about what could happen over 2 to 4 years. What happens in 10 years? What we were talking about 10 years ago is a very different narrative than the one we're having today. 10 years ago, we thought the world was over. And it would never, why would anyone ever trade something ever again? And yet today it's like, okay, what I could have a conversation what I want to trade over the next 5 or 10 days. Those are conversations I had 20 years ago. But now I think people are looking more to what can we know? What can we have some confidence in terms of our outlook? Because it's hard to know what the next data point is going to be, which drives, are we happy or are we sad? And predicting the outlook of the next data point is a skill I don't have. But in terms of bigger picture trends, people are forming families. They are going to move out of basements, taking that somewhat longer term perspective.
You should always be happy, though, Gary.
I try.
I mean, don't let data points determine your happy. You're living at the greatest period in history, in the greatest country, in the period, in all of history, and here you are on Squawk Box, on top of everything else. Huh? Being interviewed by Andrew Ross Sorkin, one of the leading
God bless you, Joseph.
journalists.
I mean, what an optimist today, and so kind.
For a Tuesday, which is like not the greatest day of the week.
You're like sunshine.
Too close to Monday, too far from Friday.